So, good evening, all the participants over here. And I once again thank to the entire fraternity who is here on behalf of the CECL and CEA committee. The chairman, sir, Sri Dr. Rajkumar S. Adukia, as well as the vice chairman, sir. And, it's really a great honor that we have got a very renowned speaker to come here and talk on the topic foreign investment in India, especially if you have read the news today and how the NGOs have been restrained from accepting the foreign funds under certain categories. And, such constraints can be dealt by, when we have got experts like CA Rajesh L. Shah, who is here. See, Rajesh L. Shah has a vast experience of 3 decades. Awesome. It's like huge, humongous. And he's specialized in field of FEMA, international taxation, structuring, transfer pricing, arbitration, etc., etc. A lot of things. So you could share, if you want, you could share your, contact details also with the participants over here so they can get in touch with you towards the end of the program.
Yeah, it's there at the end of the presentation.
Fantastic, sir. Fantastic. Then he is also guided on various trusts on Foreign Contribution Regulation Act, advising permission from the Ministry of Home Affairs. He has co-authored a book. I correct myself. He has co-authored a book, Tax Withholding from Payments to Non-Residents, which has been released by the Chamber of Tax Consultants. It's a big honor. He is also a co-authored article in FEMA WRC reference, sir. He's also contributed to various articles for Chamber of Tax Consultants, Times of India, Fortune India, etc. He is an immediate past chairman of the International Taxation Committee of the Chamber of Tax Consultants. He was a member of the International Tax Committee of WRC and a past convener of Churchgate CPE Study Circle. So here we have got C. Rajesh L. Shah, who's going to take it ahead from here. And I'm sure we're going to have a really powerful and awesome session going on. Sir, all to you. Please go ahead, sir.
Yeah, thank you, Dr. Salim, for such nice brief introduction and nice words of encouragement also. Well, friends, welcome to this session on FDI, popularly known now as, although it is popularly known as FDI, but it is NDI rules, non-debt instrument rules, which have been effective from 2019. So now, instead of 20 or 20R, which we used to refer to earlier, now we have to refer to NDI rule, non-debt instrument rules. This is a very vast topic, very, very vast topic, and it cannot be covered under within 2 hours. It is impossible to cover within 2 hours. So what we'll do is, I have made the presentation entirely for all the schedules and everything. So we'll do what is important and which is daily, day-to-day use, so that we can just have a go through it. And we will skip something. And I have not covered sector specific, because sector specific is again a topic by itself. Each sector can take 2 hours of this. So as per the mandate given, I should go through it and deal with important schedules and everything, so that there is no when the mass majority of the participants or members are attending this, so then when they are dealing in day-to-day life, they can just advise their clients about it. So let us now go ahead and move ahead. Yeah. So what is the presentation laid down? This is the presentation laid out which we will be having. Recent developments, non-debt instrument rules, that is rule 1 to 22. Then we'll be saying schedule 1, purchase or sale of equity instrument of an Indian company by a person resident outside India. Then rule 23, downstream investment. Schedule 2, purchase and sale of equity instrument by foreign portfolio investment. Schedule 3, investment by NRI, OCR, non-repatriation. 4 on non-repatriation. Then 5, by non-resident investors. 6, Indian LLP investment in Indian LLP. 7, investment by SEBI registered foreign venture capital venture. 8, investment in investment vehicle depository receipts by PROI, and 10th is Indian depository receipts. So this is the presentation layout. We will deal with one and one, and which will not important or not important in day-to-day life. We'll just go through it. Now, what is the recent developments like? Although it is 2, 3 years, 4 years back, June 17, FIPB was abolished, and all the permissions that we used to take from FIPB now has been given to the respective ministries or departments. So now FIPB has been approved. Now for each permission, say under approval route, then you have to go to the respective departments, respective ministry which you have to do. And the DIPP role which has, that is overseeing the application filed on the FIPP portal and looking forward for the administrative ministry. So now the policy making, which was there with the RBI first, because they used to indirectly they used to issue the circulars regularly, and that this used to cover the policy. But now, as far as FDI is concerned, central government has taken the power in 2017 by abolishing FIPB and by issuing the non-debt instrument rules, which was issued by the central government in 2019, and scrapping 20 and 20R because it's subsumed in that. And also FEMA notification 21, that is immovable property. Immovable property is also part of this non-debt instrument rule, which earlier we used to do separately under the 21, notification 21. But now it is a part of this non-debt instrument rule. But we will not be covering in this because we are dealing with only with FDI. So, and now with this scrapping of FIPB and everything, now they have developed a new reporting system, FIRMS, Foreign Investment Reporting and Management System. So all the reporting, as far as FDI is concerned, that is always on the form. And then under the FLAIR system, you have to file a foreign liabilities and assets information reporting. So these are the major changes which they have made during the last 4-5 years, and everything has now been covered and within the loop of central government, although it is managed by RBI. So now only the RBI has the management role. So now if you see the circulars which comes up hardly covers FDI policies, and it is the notification which as recent as notification was issued on 12th of April, which I have covered in respective places wherever it was changed. So already I have covered it. And now with this non-debt instrument rules, they have also come out in reporting factors and also notification number 395, which deals with the remittance factor. So here they give the non-debt instrument, they give the policies, and whereas the 395 says how the remittances are to be made by the foreign person resident outside India, and by how will you give the proceeds to the non-resident once you go sell off or close the. Now they have introduced the factor of late submission fee. Late submission fee vis-a-vis the compounding fee. Previously, whenever there was a delay, we used to go for compounding. But now they have introduced the concept of late submission fee. Late submission fee is only for the purpose of late filing of return. Let's say FCGPR. So if you file that, that is only the late submission fee. But if there are other violations, then still you have to follow that compounding rules. But even in late submission fee, if you feel that if you go for compounding, then there will be less fees or something, then you may go for compounding also. That they have clearly clarified in the FAQs which they have issued. So either you can opt for late submission fee or you can go for compounding. But it is always better that you, if unless the amount is too high, you pay the late submission fee and you finish the matter, because otherwise then you have to subsequently go for compounding, which may take another maximum 6 months or so. So as I told you, 20 and 20R was substituted by this non-debt instrument rules 2019, and the powers have been now vested on the central government. Now let us go straight to NDI rules 2019. Rule 1 to 22 first we will deal with, and then we will go to rule 23, which is a downstream investment. Now they have defined debt instruments and also non-debt instruments. What does debt instrument means? Government bonds, corporate bonds, tranches of security structure, borrowings by Indian firms, depository receipts whose underlying securities are debt securities. And non-debt instruments, which we are more concerned with, are all investment equity in incorporated entities, that is public, private, listed, unlisted. Capital participations in LLP, instrument of investment as in FDI policy, equity instrument, as we will see how as and when we go ahead, we'll see that now they have clarified equity instruments. So what does equity instrument that will be? Investment in units of AIF, REITs and investment vehicle. Investment in units of mutual fund where they invest more than 50% in equity. Equity tranche of each layer. Acquisition, sale or dealing directly in immovable properties. Contribution to trust. As Dr. Salim Khan said, today there is a news that how they are keeping a watch on the trust, because that is now creating a lot of problems and lot of irregularities have been noticed by them also. I have been handling certain cases and there are a lot of irregularities by the trust and they have diverted the funds, and therefore this high-handedness by the central government. I would say that because it's now too much tightness, we can say that has been brought under the rules, not only under this, but under FECRA also, because FECRA also they have tightened the regulations and also the reporting part also of it, where they have also said that now you have to open the bank account in this branch only. So they have tightened the rules and they are trying to streamline everything according to that. And depository receipts issued against equity ornaments. All other instruments which are not notified as debt or non-debt instruments shall be deemed as debt instruments. So if you are not notified here, your investment doesn't fall under this, then you will be treated as debt instrument only. Now these are the chapters under the NDI rules. Rule 1 is preliminary, rule 2 is definition. 3, 4, 5 general conditions applicable to all investors. 6, 7, 8 and 9 investment by person resident outside India, which will be more concerned with. 10, 11 investment by FPI. 12, 13 investment by NRI, OCI, investment by other investors. Then 16, 17 investment by FPCI. Then 18 to 23 general provisions which are there for merger, acquisition, startup, everything. Then 24 to 33 acquisition, transfer of immovable property. And there are under various places that they have said that in consultation of RBI with the central government. But notifications are issued, so they are issued in consultation with them, with RBI. These are the schedules which I have gone through earlier. This will be dealing. Now let us see first the important definitions which are equity instruments, because under the equity instrument, person resident outside India will invest in equity instrument, which means equity shares, convertible debentures, preference shares, and share warrants. These are the 4 categories of, mind you, convertible debentures it is. Equity shares will include partly paid up shares. Convertible debentures will have to be fully and mandatorily be convertible. Preference shares are also fully and mandatorily convertible preferences. And share warrants issued according to SBI regulations. Equity instrument contain an optionality clause subject to a minimum lock-in period of 1 year. Then partly paid off shares has to be fully called up within 12 months of such issue, and 25% of the total consideration, including period, shall be received upfront. In case of share warrant, 25% of the consideration shall be received upfront and the balance within 18 months of the issuance of share. So FDI-linked performance conditions means the sector-specific conditions specified in Schedule 1 of these rules for companies receiving foreign investment. So whenever you are going under Schedule 1 and say there are sector-specific, say for real estate, they put conditions on it. Say retail trading, there are various conditions attached to it. So that means FDI linked performance conditions. So wherever there is a performance conditions, they have defined it as FDI linked perform conditions, because whenever you are dealing with certain issues like LLP investment or something, they always link it to FDI linked performance conditions with their IM. Now what is FDI? Means investment through equity instrument by a person resident outside India. PROI means person resident outside India in an unlisted Indian company or in 10% or more of the post-issue paid-up equity capital. That means FDI means If it is an unlisted Indian company, then it is always an FDI. And listed Indian company, 10% or more of the post-issue paid up equity capital. So these things you'll have to give. If the existing investment falls to a level below 10%, the investment shall continue to be treated as FDI. So even if suppose if you are now 12% before you have invested, now you fall to say 7 to 8%, but still it will be treated as an FDI. What does foreign investment mean? Means an investment made by a person resident outside India on a repatriable basis in instruments of an Indian company or to the capital of a LLP. So investment made by a person resident outside India on a repatriable basis, and that's why we are going under Schedule 1. If it is under non-repatriable, then you go under Schedule 4. Foreign portfolio investment. We have seen foreign direct investment, which says that if it is in unlisted, then it is always an FDI, and if it is in listed equity, then it will be treated. If it is more than 10%, then it will be treated as FDI. But if it is less than 10%, then it will be foreign portfolio investment. So these are the two distinctions which have been made between the two. Foreign direct investment and foreign portfolio investment. More than 10%, you go under FDI. Less than 10%, you automatically fall under foreign portfolio investment. Government approval. There are various, in Schedule 1, they have all mentioned where government approvals are required. What is the percentage that is under automatic route, and what are the percentage above that which you have to take above that. Above that, you will have to take the permission of the government. Here I have mentioned erstwhile FIPB, but now you, because or the erstwhile FIPB, because still that certain people are there which are working, because they advise the government or the ministry on how to proceed about it. So ultimately the power has been vested on the respective ministry now. And they are assisted by Secretary for Industrial Assistance and FIPB both, because still, although it is scrapped legally, but indirectly they help them. Group company means two or more enterprise which directly or indirectly are in a position to exercise 26% or more of voting rights in other enterprise and appoint more than 50% of members of the board of directors in another enterprise. So group company, 26% you exercise the voting rights and appoint more than 50% of it. Or hybrid instrument we have seen, such as optionally or partially convertible preferences, dividend, debentures, and any other instrument as well. Indian company. Indian company, I'll not go through it because it is as defined by the Companies Act or a body corporate established or constituted by or under. So for Indian company, you will have to go to Companies Act 2013, and I've given it what is what is Indian company. Investment. Investment means to subscribe, acquire, hold, or transfer any security or a unit issued by a person resident in India. Investments will include to acquire, hold, transfer depository receipts, and for the purpose of LLP investment, it shall mean capital contribution or acquisition or transfer of profit shares. I've just taken key definitions which we are going through it because it may be helpful when we are just going through other slides also. Investment on repatriation basis is sale or maturity proceeds of which are not of tax value to be repatriated of them. So sale or maturity proceeds, or you may say investment, they are permitted to be repatriated outside India. And non-repatriation means accordingly they are not permitted to repatriate outside India. Investment vehicles means real estate investment trust, infrastructure investment trust, and alternative investment fund. Indian entity shall mean an Indian company or a LLP. Investing company means an Indian company holding only investment in other companies directly or indirectly. And it is holding it not for the trading purpose. It is just an investment vehicle which we call it as. Because investing company, that's why they have named the company as investing company, although it may be taken as an investment vehicle, because what we do is investment vehicle, say I'm a foreign company invest in company A, and in turn company A invest in various other companies. but it is not trading in that. It is for the purpose of portfolio FDI investment, which is there because of certain reasons. For certain purposes where they have set up the factory or anything. So for the purpose of FDI schedule, one purpose that they have opened. Listed Indian company means recognized in all the stock exchange. Share-based employee benefit, which is now the new concept which the government is introduced. Issue of equity instrument to employees or directors of the holding company or joint venture or wholly owned overseas subsidiary who are resident outside India pursuant to share-based employee benefit scheme. It's similar to ESOPs or other. In this share-based employee benefit schemes, shares are issued to the employees and other similar benefits are also given. Whereas in ESOPs, shares are issued. It's similar to ESOPs, that's just that the other name which is given. Now manufacturers. This is the first time I think we must be seeing the manufacturer, and it's exhaustive like a non-living physical object or article or thing. Non-living object, article or thing, resulting in transformation of the object or article or thing into a new and distinct object. So resulting in transformation into a new and distinct object or article or thing have a different name, character and use, or bringing into existence of a new and distinct object or article thing which with a different chemical composition or integral structure. So through different chemical structure and when you mix various chemicals and you bring out a new product, then also it is called a manufacturer. Then sectoral cap. Sectoral cap means the maximum investment, including both foreign investment on a repatriation basis. I will explain to you in brief. Sectoral cap means what? In certain industrial defense, and 49% have been specified. Okay, now 49% you can invest up to. So that is the maximum cap which you should not breach. That is the maximum cap you can allow to invest. So that is the maximum cap which you are allowed, and that you should not breach under any cap. If it is above 49%, then you have to go for government approval. So this is the short and substance of the meaning of the sector. So now we can see what is the distinction between FDI and foreign portfolio investment. As we seen, foreign investment in unlisted company always treated as FDI. Foreign investment of 10% or more in listed companies, then always FDI, even if by an FPI percentage threshold matters. That means it is always FDI if it is 10% or more. But if it is 10% or less, then it is FPI. And if that 10% or more which you have invested in FDI, if it reduces, then again it is probably falling below, then it will remain as FDI and not change the method. Rule 6 now will go to investment by person resident outside India and in Indian company. Person resident outside India can subscribe, purchase or sale of equity instruments of an Indian company, subject to terms and conditions of Schedule 1. Equity instruments, we have seen what it is: equity, convertible preference share, convertible debenture, share warrants. These four things are covered under this. An entity of a country which says land border with India, or the beneficial owner of an investment into India, who is situated in or is a citizen of any such country, sir, invest only with government approval. This is specifically for China, which India had brought into it to stop Chinese from taking over the Indian companies, because at that time the share market has crashed like anything, and there was a fear that they might overtake the companies. So that's why these restrictions have been brought into it. It's not only that direct investment from those countries, but indirect investment that also has been covered. Say, for example, there is a US company where the beneficial owner, that means the owners are Chinese nationals or Chinese companies, then also they are not permitted to invest in it. They have to come under government rule only. So this you'll have to be very careful. Because you must have seen in recent months, last couple of months, that many companies have fallen into the trap of enforcement directorate and various CAs and CAs who are involved in forming the company, they have been taken into, they have been questioned by the enforcement director. So you will have to be extremely careful while seeing the investment, especially the beneficial owner. You will have to go right up to the end. Suppose if there are companies, then again B company, then again C company. There are multiple layers, say 4-5 layers, then you will have to go up to the end and find out who is the ultimate owner that is there. And even if it is found that at the fifth, sixth layer also, if you find that there are Chinese nationals or anyone which is having a land border with India, which says land border, then also you will not be able to invest it without government approval. There are always questions of whether Hong Kong is covered under this, because Hong Kong doesn't say land border with India. So they should be permitted. Per se, yes, they should be permitted. But again, as I said, you'll have to be very careful, because Hong Kong now is almost like a part of China. So what happens that most of the companies which are in Hong Kong, they are formed or incorporated by the Chinese nationals or other countries, but mainly by Chinese nationals. So they are always in lookout for finding some loopholes, all the land border countries, to again invest in, circumvent some route and try to come into India by any other mode. But then these are all the factors which you have seen. Even if you have to be extremely careful while saying this, that who is the beneficial owner. And obviously the citizen of Bangladesh, Pakistan, or entity incorporated in Bangladesh or Pakistan, they are not allowed to operate in, they are not allowed to make a capital contribution or acquisition or transfer in LLP, investment in unit of an investment vehicle depository. Rule 7, rights or bonus issue of an Indian company. There is always rights issue which comes up with the company, always bring up, because they are needs of the fund. And if they are cash rich company or showing good profit, they always issue bonus shares. And that is always permitted, that is not a good. But this is permissible only subject to same terms of original issues. That means at the initial stage which you had issued, and now you are issuing right issue or bonus issue, then it will be at the same stage. Shall not result in breach of sectoral cap. There should be never a breach of sectoral cap, either rights, because what happens that once you issue rights, say to person resident in India, then he renounces. That is also not permitted. And the terms and conditions which are being issued, then it should be both equal for, say, person resident in India and person resident outside India. If it's a WS, then there is nothing you can do it. But you have to see that if the WS also doesn't violate the sectoral cap, but that you must have seen at the initial stage only, or you must have taken the government permission. And in right issue by listed company, prices determined by the Indian company, which is in consultation with the SEBI, and in unlisted Indian company, the price shall not be less than the price offered to person resident in India. That means that if you are issuing the shares on right basis to person resident in India at 100 rupees, then to person resident outside India, you cannot issue at 80, 90 rupees. It has to be same. Or you can take more. That is not a problem, because here it says it shall not be less than the price offered. Say I issue it 120, there is no problem for that, because ultimately India is getting a foreign exchange, and secondly the investment, it comes as a share premium and not as a share capital. And person resident out there exercising rights which was issued when she was a person resident in India, shall hold the equity instruments on a non-reportable basis. Suppose I am an Indian, a resident Indian, and I had formed a company over here. I am a director, shareholder, everything. Now I go outside India. Now I'm a non-resident, person resident outside India. So I have to continue to hold it on a non-repatriation basis only. And Rule 7 says additional rights and renunciation of rights by person resident in India in favor of person resident outside India is subject to pricing guidelines as per Rule 21, which we will see later. What is the pricing guideline? Now, ESOPs and sweat equity shares to person resident outside India, obviously to other than citizens of Pakistan, Bangladesh. But again, that land border remains because that is the main part which they have covered. So even if it is not in respective rules also, that you will have to take care of that. So issue of shares under ESOP strategy seems share-based employees permitted to be issued by an Indian company to its direct employee or directors, employee directors of its holding company, joint venture, wholly owned subsidiary or subsidiaries who are persons resident outside India. Because if they are person resident in India, then this rule will not apply. So they have to be person resident outside India, and then they are given this benefit. The scheme obviously has to be drawn in SEBI with SEBI guidelines and Companies Act. Sectoral cap, as I've said, you have to see the sectoral cap can be breached. If sector is under approval route, then take the approval of Government of India again to be held on non-repatriation basis by person resident outside India, exercising option which was issued when he was a person resident in India. So I am a person resident in India. So I have been issued as the ESOPs. So I am holding it now on non-repatriable basis because I am person resident in India. So tomorrow, if I become person resident outside India, I will continue to hold it on non-repatriation basis. NDI rules for transfer. Now, there are always once you invest, there might be situations where you want to transfer your equities to either by sale, gift, or any other mode. So there are various regulations which have been prescribed under Rule 9. Coming to Rule 9.1, say person resident outside India, the seller part. Person resident outside India, other than NRI, OCI, and OCDs, want to sell or give to person resident outside India. Then no pricing and reporting guidelines are there. And sector under approval route, yes, you will have to take approval. Otherwise, no, because this is from person resident outside India to person resident outside India. Therefore, there was no pricing and reporting guidelines which are the government approved. But in FCGPR, it is better that you report it, because what happens that when you are changing the name, although it says that reporting guidelines is not there, but in FCGPR, when you are changing the name, it is always better, because afterwards, subsequently, if you are selling it, then you might face into the problem and you may have to complete everything on back basis, and you may have to pay compounding fees and late filing fees. So it's always better that you report it under FCGPR, and or write a separate letter to them that okay, these are the things which we have done. So what does it covers? Transfer pursuant to liquidation, merger, demerger, and amalgamation of entities or companies. Then person resident outside India wants to sell or gift to person resident in India, which is again subject to reporting guidelines and pricing guidelines, except when PROI holds on a non-repatriation basis. And where there are no government approvals. Where there are government approvals, obviously will require. But when there are no government approvals, there is nothing. So person resident outside India, selling it to person resident outside in India. Sorry, there is no government approval in this because it is selling to person resident in India. So there is no government approval on this. Person resident in India, selling it to person resident outside India. Obviously, pricing and reporting guidelines is always there, and government approval will be required if there are sectors under approval. And the sale, this is only a sale. You can person resident in India can only sell to person resident outside India. He cannot gift it. So sale will be in compliance with entry routes, sectoral caps, or investment limit, pricing guidelines, and other all the conditions which will be there. Then 9.4 says person resident in India or NRIs and OCIs on non-repatriation basis sells to person resident outside India. Sorry, gifts to person resident outside India. 9.3 we had seen that it was only sale part. 9.4 now we are saying it that it is a gift part. So gift part will work covers person resident in India or NRIs and OCIs on non-repatriation basis now gives to person resident outside India with prior approval RBI approval less than 5%, and they cannot exceed more than 5% of the paid up capital of Indian company or each series of debentures, and aggregate ceiling of USD 50,000 per financial year for donor and not donee. So they can only gift, person resident in India can only gift up to 50,000 USD per financial year and should not exceed 5% of the paid up capital of the Indian company. And sectoral cap should not be breached, and donor and donee should be relative as per the Companies Act 2013. So both should be relative. And the pricing guidelines has to be followed. So USD 50,000 per financial year, which is the quarter donor, it has to be according to the pricing. 5% of the paid up capital is for the breach of the limits. But when you are counting the for that 5% of the paid up capital, so 10,000 say shares are there in paid up capital of the company, then 5% of it is you'll have be able to gift only 500 shares. But again, that has a cap of 50,000 USD. Say 500 shares are there, but 500 shares the value comes to $1 lakh, which is not permitted. Then you will be restricting it to USD 50,000. Person resident outside India holding instruments of an Indian company with optionality clause can exit without any assured return subject to pricing guidelines and minimum lock-in period of 1 year. Now, sale on a deferred consideration. Sometimes what happens that the purchaser might not having the immediate fund, so they sell it to on a deferred consideration basis. So person resident in India sells it to person resident outside India on a deferred consideration basis, which should not exceed 25% of the total consideration. Deferment period not to exceed 18 months from the date of transfer agreement. It can be settled through escrow arrangement and can be indemnified by the seller. And obviously the pricing guidelines always applicable. And the period of 18 months from the date of payment of the full consideration if total consideration has been paid by the buyer of the seller. So there are always chances that sale on deferred consideration is always there. Or why they adopt is that sometimes there are no money or certain terms and conditions have to be fulfilled by the seller. And that's why they go for the deferment period and they open an escrow account. And if it doesn't particular that terms and conditions are not fulfilled, then the deal is cancelled. That way, that's why this is there. Escrow account to be opened in accordance with the FEMA regulations, FEMA deposit regulations, and it can be funded by either inward remittance or AD bank guarantee. Then the equity instruments which are there you are permitted to pledge it for obtaining an ECB from the company registered in India. So pledge for ECB is subject to conditions. Pledge period of pledge should be continued with the co-terminus with the maturity of underlying ECB. That means that if your ECB for 5 years, then pledge should be always be also for 5 years. It cannot be 7 years or it cannot be for 3 years. It must have been the same period. In case of invocation of pledge, transfer will be in accordance with rules and directions of RBI. As we have seen the transfer, all the rules and regulations will have to be complied with. Statutory auditor has certified that the borrowing company shall utilize or has utilized for the permitted end use only. How can statutory auditor satisfy that he will utilize? I don't think so, but subject to that, whatever it is, because the institute guidelines also says that yes, you can do it subject to certain notes which you have to put it into your certificate. And NOC from AD that all the conditions have been complied. Pledge of equity instrument by person resident outside India for credit facilities to Indian companies. So again, either you can give pledge of equity instruments either for obtaining ECBs or for credit facilities to Indian companies. So there they have permitted to give this, to pledge the equity instruments. Equity instruments, we have seen what it covers. Pledge in favor of overseas bank by person resident outside India who is the promoter of an Indian company, or he can pledge it to NBFC. And in case of invocation of pledge, again, entry rules, sectoral, pricing guidelines, other to be complied. All has to be complied. Startup India. Startup India, which is there. So there also the startup Indians are companies are also permitted to take FDI through convertible note. A startup company means a private company incorporated under the Companies Act and identified under GSR 180, whatever it is, issued by department. I'm not going into that details what our industries are covering. Convertible convertible note is an instrument is issued by startup company evidencing receipt of money initially at debt, which is repayable at the option of the holder, or which is convertible into such number of equity shares of such startup company within a period not exceeding 10 years. Previously, it was 5 years. Now it has been changed to 10 years from notification 12th April. From the date of issue of the convertible note upon occurrence of specified event as per the terms and conditions. Why this convertible note is? Because when you are a startup company, the investor is not sure how this project will work, how this industry in which he is investing will work. So what they do is they give it as a convertible note. Initially it is debt. So if he wants, he can take it back at the option of the holder because it is repayable. So he wants, he can take the amount back, or he can convert it into number of equity shares. And it should not be for more than period of 10 years. Why it is not covered in FDI? Because if you what we have seen is equity instruments include equity share capital, convertible debentures that is convertible, and convertible preferences that is mandatory. Here there is an option that's why there is a separate regulation rules for this. Person resident outside India permitted to invest issued by startup of 25 lakhs or more in a single tranche. So minimum 25 lakhs is required and they can invest in single tranche. And if it is sector is under approval, then obviously then government approval is required. For Indian startup issuing convertible notes to person residents outside India to report to RBI within 30 days from the issue. For transfer of convertible note between person resident outside India and person resident in India, and to be reported by person resident in India within 30 days from the date of transfer. So this is the reporting part which is always there. In the case of merger, demerger, amalgamation, the shares are issued by the amalgamating company. The issue of equity instruments to persons outside India permitted under this. The transfer issue to be in compliance with entry rules, sectoral cap, everything. Again, you will have to apply. If there is under government approval route, then you will have to take the government approval, and the company which is being formed, transfer or new company, whatever you say, then it should not be engaged in prohibited sector, and also the scheme has to be compliant with SEBI guidelines if it is listed on the stock exchange. Now, what are the reporting part? Because on each and every stage, wherever you are investing, there is always to be reporting. And what is the timeline for it? Because if you don't adhere to the timeline, then again you will have to go for compounding or late filing. So FCGPR. FCGPR, Indian company issuing capital instrument to a person resident outside India. Also in case of conversion of ECB into equity along with form ECB2 has to be filed on the firm's portal within 30 days from the date of issue of capital. Now it is equity instruments which you can see. Indian company which has received FDI or an LLP which has received investment by way of capital contribution by 15 July of next year, he has to file FLA return. FLA return gives what are the investment, how much, what you have earned, dividend, and all what you have earned is dividend, whether you have taken up, whether what is the investment, whether you have made sale to your sister concerns, what you have received from them, all the details you have to give. So that you will have to be filed. So for 21-22, you will have to file it by 15th of July 22. FCTRS, that is for transfer of capital instruments. That means what we have seen, that from person resident outside India to person resident in India or vice versa, you have to report in FCTRS within 60 days of transfer of receipt or remittance. ESOP, you have to submit within 30 days by the Indian company who is issuing employee stock option to the person resident outside India. If it is in India, then you don't have to. Then depository receipts, again, you have to report on 30 days from the date of close of issue. LLP1, receiving amount of consideration for capital contribution and acquisition of profit shares, they have to file it within 30 days from the date of consideration. And if there is a disinvestment or there is a transfer of capital contribution of profit shares between resident and non-resident, then they have to report within 60 days from the date of receipt of funds. Then purchase of equity instruments by FPI on the stock exchange, that is not applicable. Again, I have written because there they don't have to, because stock exchange and the reports again, AD2 report to RBI. So we are not concerned with it. Authorized dealer automatically. Again, LEC, NRI, that is also again authorized dealer have to report to RBI, and we are not concerned. Indian entity or an investment vehicle making downstream investment in another Indian entity, 30 days from the date of allotment. Indian startup company issuing convertible notes to a person resident outside India, then 30 days of such issue. And investment vehicle which has issued a unit to a person resident outside India, 30 days from the date of issue. We have seen by and large all these are the reporting and due date. Mostly it is within 30 days, except for one FCTRS which is within 60 days. So you have to be extremely careful. And disinvestment of LLP or transfer of capital, that is 60 days. So you'll have to be extremely careful with the timeline, and you don't keep it up to the end, because what happens that if you keep up to the end and site is also not working properly, or there may errors, or there are certain information which they may ask which may not have been readily available to you also. So you have to be extremely careful. And if everything is okay, then you can file it on immediately within 10 to 15 days. Now pricing guidelines. Rule 21. What are the pricing guidelines for issue and transfer? If the sale is governed by SEBI guidelines or price is specified by SEBI, then pricing guidelines under Rule 21 does not apply. This is mostly for the listed companies which is there. So issue price for listed company, SEBI guidelines including for delisting. For unlisted company, internationally accepted pricing methodology for valuation on arm's length basis, and the valuation can be done by merchant bankers, CAs, cost accountant. CCPs, that is compulsory convertible preference shares and compulsory convertible debentures. Price conversion formula to be determined upfront, and price should not be less than fair value on the issuance date. So for shares, internationally accepted pricing methodology, valuation to be done by merchant bankers, CAs, cost accountant. CCPs and CCDs, price conversion formula to be determined upfront. Also, price should not be less than fair value on issuance date. That means if your fair value is say 100 rupees, then you cannot issue it less than 100 rupees. Transfer of shares, equity instruments from person resident in India to person resident outside India. Listed company should not be less than SEBI guidelines. Issue of preferential allotment or delisting. And for unlisted company, internationally accepted pricing methodology for valuation on arm's length basis. And again, valuation by merchant banker, CA, cost accountant. And person resident outside India to person resident in India, same way, everything is the same. So this will have to be, and now registered valuer are also there. So they might give it to registered valuer also. But that they have not been specified. So just now it is with merchant banker, CAs and cost accountant. Person resident outside India. they cannot be guaranteed any assured price. So suppose if I am an Indian company and I am a director of that shareholder, owner of it, I tell the overseas party to invest in me. I cannot assure him that after 7 years, 10 years, you can exit at 500 rupees, 1000 rupees, or 700 rupees. No. Whatever is price at that time, it will be determined at that time and not. You must have seen the Tata Docomo case which was there and it had gone for long years. Same thing is because the price was assured to them and then government said no and it had gone into litigation for a very, very long time. Swap of equity instrument valuation by merchant banker registered with SEBI and investment bankers outside India, they are also permitted, but it is registered with appropriate authority in the host country. Subscription to memorandum of understanding, investment at face value and entry route and sectoral caps applicable. Because in this subscription to memorandum, there was always a question whether you have to invest at a premium or valuation you have to do. So now they have clarified that it can be at the investment at a face value, because initially when you invest it, you don't know what will happen in future. And in share warrant, pricing conversion formula to be determined upfront. So price share warrants, compulsory convertible preference shares, compulsory convertible debentures, all the price and conversion formula have to be determined upfront, and it should be less than not the fair value. This should not be termed as this exit price, assurance of exit price, because here you are issuing this, as we have seen, this price conversion formula to be determined upfront. So this should not be seen as a guaranteed assured price, because here you are converting from debt to equity and you are not repaying them. So there should not be a confusion between them. Here it is a repayment where you can do. There it is a conversion. Share warrant is also converted into equity. That's why the share price has to be determined. Pricing is not applicable for investment by person resident outside India on non-repatriation. So if you have come under Schedule 4, then you don't have to comply with the pricing. All transactions through banking channels, remittance of sale process, when you are remitting all the sale process, when you are wound up or you transfer your shares, then all the transactions have to be through banking channels. All the taxes, applicable dues also should be there. And security should be held on repatriation end basis, and it has to follow the pricing guidelines or with prior approval in other cases. Because if you don't follow the pricing guidelines, say as per you the valuation is say 1,000 rupees, but then there is no conformity between agreement between the buyer and seller, and they say 700 is the fair value, then you'll have to go to RBI for the approval. Now Schedule 1. Purchase or sale. This was what we had was NDI rules. Now we are going into purchase or sale of equity instruments of an Indian company. An Indian company to issue equity instrument to payers subject to entry rules, sectoral cap at another conditions. Sectoral caps and government rule indicated again each sector in the schedule to be complied with. So 49, 74, 100%, whatever is there in the terms and conditions also. That also you have to comply with. Sectoral activity is not listed in table of Schedule 1. That means if it is not there, that your activity is not there on the Schedule 1 list, then 100% automatic. But still, you have to comply with the formula, this FCGPR and forms and everything you have to find. There is no FLA form and there is no relaxation. So please be mindful that even if it is 100% automatic, then still you have to comply with all the procedures. SOP issued by DIPP specifies process and Minister of Government approval route minimum capitalization to include premium received by the company. So whenever there is a minimum capitalization clause or restrictions, then it will include premium also. And amount paid by transferee during post-issue transfer beyond the issue price not to be calculated for minimum capital. So that also they have clarified that okay, for minimum capital requirement, post-issue there is a transfer, then you do come. Beyond the issue price, then you don't consider. Sectoral policy, again, approval route for investing companies not registered with RBI, NBFC and NCIC. So Investing company not registered, they will have to go for approval. I don't know how many investing companies are functioning without RBI approval, but still they have specified. Investment company registered with RBI as NBFC 100% automatic. There is no problem. An Indian company with no operations and no downstream investment under automatic route, only if activities are undertaken under automatic route and with no FDI linked performance. Again, no operations and no downstream investment, again under automatic route, only if activities are under automatic route and no FDI link. Government approval route, then again you will have to take government approval. If person specifies a particular audit firm to audit a firm, that means there is a group company from outside India and they want to invest in India as 1,000 crores. They want to say that particular firm of auditors should be on this. Then once you say that this, they say that okay, this should be a statutory auditor, this firm, then you will have to have someone, another auditor as a joint auditor who will not be a part of the same network. That means a third party auditor will have to be as a joint auditor. What are the prohibited sectors? As you know, lottery, then gambling and betting, chit funds, nidhi companies, trading in TDRs, real estate business. We'll see the definition. What does real estate business or construction of farmhouse, manufacturing, cigars, cheroots, cigarettes, all this tobacco things, all these tobacco items are banned. Entry routes, automatic, no prior RBI approval, government rule prior approval. Aggregate foreign portfolio, investment not requiring government approval, investment up to 49%, and no transfer of ownership and control of Indian company from resident Indian citizen or transfer of ownership or control to person resident outside India. Again, prohibited sectors, these are foreign technology collaborations prohibited for lottery business and gambling, betting, including licensing and all this. And the activities which are not open to private sector, that is, it is reserved for PSUs, atomic energy, railways, all these things are also not covered, and they are prohibited. Now, real estate business means dealing in land and building, land and immovable property with a view to earning profit from there, and does not include development of township, construction of residential or commercial premises, roads or bridges, educational institutions, recreational facilities, city and regional level, township, real estate, broking business, all this does not include. All these are not covered. And earning of rent or income on lease the property not amounting to transfer. So what does it mean? Real estate business means dealing in land with a view to earning profit. That is fine. That is a basic thing. But does not include what? Development of township, construction of residential or commercial premises, educational institute, real estate investment. These are all not covered as a real estate business. And also earning of rent or income on lease of the property. That is also now not real estate business. So if I purchase a property and give it on lease, that is not a real estate business. Automatic route with or without conditions. These are all the sectoral cap which I have just given the chart in a brief, but still you have to go through schedule 1 and you will have to look into the schedule 1 thoroughly, minutely, and the terms, conditions which are attached to it, what we call as FDI linked performance. So that also you have to thoroughly comply. Person resident outside India to purchase share in listed company on stock exchange of India if person resident outside India acquired control as per.
Sir, here in between, I have a small input for you. If you could go in the chat box, you'll find there are some 3-4 questions.
Okay.
So if you can take that and attend to those questions and then proceed further, that will be really great of us. Because then the flow of those questions would be lost if we keep it pending for the last minute. A request from me, if it is possible.
Okay.
So are the questions visible to you, sir?
Yeah.
Exactly, sir. So there are 4 questions, sir. A humble request, if you could please attend that, and then you can continue. Please.
Yeah, regarding this downstream investment, we'll take it up once we go into the downstream investment.
Fantastic, sir. Fantastic. Your call. Your call.
9(1), difference between 9(1), 9(2), 9(3), and 9(4 as it is confusing. Can we issue shares less than its FMB as per CB merchant banker valuation? No, you cannot issue less than FMB. Because when you're issuing it to person resident outside India, the question is, can we issue shares less than its FMV as per SEBI merchant banker valuation report? No, you cannot issue it as less than FMV. So suppose the FMV as per merchant banker valuation report is say 500 rupees. So you cannot sell it below that to person resident outside India. So you have to sell it either at 500 or more. Is the company required to file Form FCGPR again on conversion of CCDs into equity? Yes, because you will have to inform the RBI that now we have converted it into the shares. So that's why you will have to file. Now coming to the question is Rule 9 of the NDI. Can you please explain difference between 912, 91, 92, 93 and 94 as it is confusing? Okay, I'll go back again to that. Yeah, here we are. Okay, now I'll read from the rules itself directly because then you will be able to understand.
Exactly, sir. Exactly.
A person, I'll read now 9(1) I'm reading. I'm going through the rules only. A person resident outside India, right? This is PROI, person resident outside India. He is a seller now. Not being a non-resident Indian, not being a NRI, other than NRI, or OCI and OCBs. Erstwhile OCB, which was the overseas corporate bodies, which they have banned, but still those who are old OCBs, they still continue. But now nobody forms OCBs or anything. So person resident outside may transfer by way of sale or gift. Sale or gift. This is sale or gift of the equity instruments to person resident outside India. Got it? So it is from PROI, person resident outside India other than NRI, OCI and OCB, to person resident outside India. 9(2) is from person resident outside India to person resident in India. Now, in this 9(2), you must be thinking that person resident outside India, yeah, all categories are involved. That means NRI, OCI, OCBs, and what we call it as foreigner. If I use the term usually, what we call as foreigners, which we say, that also are covered. So all are covered. Here only if we say then for foreigners only are covered, if we can say it that way. Because NRI, OCI means overseas citizens of India. Even if they've taken the the other country passport, then also they cannot do it. So this is that. But PROI to PRII, so person resident in India, all categories are concerned. They can sell it freely to person resident in India. There is no restriction for them. Then in the 9(3), it is from person resident in India to person resident outside India. So first two categories of person resident outside India. First is a person resident outside India other than NRI, OCI, OCBs. For two person resident outside India only, outsiders, and that can be buyer, can be NRI, OCI, and OCB. OCB will not be there because that is now not permitted. So person resident outside India can be NRI and OCI as far as the buyer is concerned. But seller can only be person resident outside India. Then under 9(2), person resident outside India sells it to person resident in India. 9(3), person resident in India sells it to person resident outside India. And 9(4), it is person resident in India, NRIs and OCIs on non-repatriable basis, as we popularly say Schedule 4 investment. They are selling it to person resident outside India. And that is with prior approval, because obviously when they had invested, it was on RBI, it was with the prior, it was on a non-repatriable basis. Because if you had invested on non-repatriable basis and now you want to sell it or gift it, that is gift it on a repatriable basis, then it will obviously require a RBI approval because it automatically comes. But even if it is you are selling it under non-repatriable basis, also purchaser is selling, then it's better that you take the RBI approval. Because otherwise, what at the most they will say is that this doesn't come under the purview and you can go according to the rules. That way, but it's better that you go. I think this is clear, right?
Fantastic, sir. Fantastic.
Person resident outside India to purchase shares in listed in company on a stock exchange of India if has acquired control as per SEBI regulations, acquisition of transfer, consideration can be paid out of payment specified by RBI or dividends by Indian investors. WS in India or NR entity can issue equity instrument against incorporation or pre-operative expenses permitted to 5% authorized capital or USD 5 million, whichever is lower, 5 lakhs. WS is engaged in sector where 100% FDI is permitted and reporting within 30 days of the issue of equity shares. Previously, there was an explanation in 20R. Pre-incorporation or pre-operative expenses shall include amounts remitted to investee company's account to the investor's account in India if it exists to any consultant, attorney or other material or service provider. So previously what used to happen that we used to take the amount. Okay, now you give us the amount and we'll spend it. That is not now covered. So what are the implications of this? The problem is that now if they want to issue the shares, then they cannot do it. That is the main implication. Because that they are not covering it as an explanation. And 20R is now subsumed. So now we cannot resort to that rules. An Indian company issue equity instrument against inward remittance through banking channels out of funds held in FCNRB, NRE, escrow accounts. So you can also permit it to swap equity instrument, import of capital, goods, machinery, equipment, pre-operative or pre-incorporation expenses, including payment of rent, NRE, FCNRB, NRI, OCIs, any funds repayable by Indian company to a person resident outside India, the remittance of which is permitted under FEMA by RBI, Government of India, or post obtaining approval. Time limits again within 60 days from the receipt of consideration. Time limits for issue of equity instrument. It is 60 days from the receipt of consideration, else refund within 15 days from the date of completion. Within 15 days from completion of such 60 days. So you have to issue equity shares. If you are not able to issue within 60 days, then you have to compulsory refund it or you take RBI permission. So you suppose now you invest on 75th day. That is not normal. And again, you will have to look at the Companies Act. What is the time period for which for issuing shares? I think there also it is again 60 days. Now they have synchronized. Remittance of sale proceeds. The consideration for equity instrument can be deposited in NRE or FCNR. So how do you invest? Banking channel, direct remittance, FCNR, NRE, escrow account. You can also issue equity instruments through swap of equity instrument, import of capital goods, machinery, equipment, pre-incorporation expenses, pre-operative expenses. This you may say, okay, yeah, okay, we have given the consultant for forming the company or his fees. That is also part of pre-incorporation or pre-operative. But it is better to write to RBI. Then NRE or FCNRB account for NRIs, OCI, any funds payable by the Indian company to person outside India, the remittance of which is permitted or post obtaining all approvals. So these are the methods in which the person resident outside India can invest in India. Now downstream investment, Rule 23. Because downstream investment now again is Rule 23. Why I have taken afterwards is because once you complete this, then what is downstream investment we can understand properly. Let's note DIPP 2009 series now subsumed in FDI policy. ADI series circular and FAQ by RBI, FEMA notification various 2020 which was issued previously, but still the master direction continues that and now the non-debt instruments. FDI policy, consolidated FDI policy, they issue every 1 or 2 or 3 years. Last time it was issued for 3 years before, afterwards in 2020, and everything has been covered under the FDI rules. But if there is a conflict, then non-debt instrument rules will prevail over the FDI policy. So whenever you are advising your clients, it is always better that you look at the FDI policy simultaneously, because there are certain sectors where it is not permitted. It will not be there in non-debt instrument. It is always better you look into FDI policy and then advise your client. Well, by and large now everything has been opened up, but still it is better that you be sure that you are the right side. Now let us see downstream investment. It is also known as indirect foreign investment, but there are two separate definitions. So now we'll see downstream investment means, because this indirect foreign investment, downstream investment, we use it interchangeably, but when we are dealing with the regulations, we'll see how it. Downstream investment means investment made by an Indian entity, which has total foreign investment in it, or an investment vehicle in the capital instruments or the capital, as the case may be, of another entity. So I've taken the flowchart also, so it is easy to understand. So suppose there is a foreign company, it has invested in Indian entity A, and in turn it's invest in another company, Indian company. So that is called downstream investment, wherein the Indian entity is invested. Now what is indirect foreign investment? Means downstream investment received by an Indian entity from another Indian entity, which has received foreign investment and in which is not owned and not controlled by resident Indian citizen, or is owned or controlled by persons resident outside India, or an investment vehicle whose sponsor or manager or invest manager is not owned and not controlled by resident or resident Indian citizen, or owned and controlled by person resident outside. No person resident in India other than Indian entity can receive indirect foreign investment. Now I'll directly first go to the investment. So now this is a foreign investor. Indian entity, I'll just put everything together. Indian entity 1, I company 1, or investment vehicle, and Indian entity 2, foreign investor has invested 100% in Indian entity 1, and Indian entity in 1 has invested in Indian entity 2. Now, let us see what this downstream means. Downstream investment means investment made by an Indian entity. By Indian entity, I have written, it is not there in the definition, which is total foreign investment. So Indian entity has total foreign investor in it, or an investment vehicle, or decided in the capital instrument of the capital, as the case may be of finance. So now this company has, I company 1 has invested into I company 2. So investment made by I company 1 into I company 2 is called as downstream investment. And obviously downstream investment again has to comply with all the sectoral caps, conditions, restrictions, everything. So Indian entity 1, when investing in Indian entity 2, it is called as a downstream investment. Now indirect foreign investment. Now again same example. Indirect foreign investment means downstream investment received by an Indian entity 2. So Indian entity 2 is receiving investment from Indian entity 1 or investor vehicle, and this is not owned, which is received foreign and which is not owned and controlled by resident India. So this is not owned and controlled by, it is controlled by person resident outside India. So downstream investment, you will have to look at vis-a-vis Indian entity 1, and indirect foreign investment will have to be looked into Indian entity 2, vis-a-vis the Indian entity 2. This is the difference, and that's why there is a two separate definition. So when Indian entity is investing into Indian entity 2, it is said that Indian entity 1 has made a downstream investment. When Indian entity 2 receives funds from Indian entity 1, it can say that Indian entity indirect foreign investment has been made into Indian entity 2 by Indian entity 1. This is the brief difference between the two, Indian entity 1 and Indian entity 2. Or you can say foreign indirect foreign investment and downstream investment. This is the basic difference which is there. Downstream, again I'm repeating, downstream investment you will have to look vis-a-vis Indian entity 1, and indirect foreign investment will have to be looked at Indian entity 2. Here I have given with examples. That's why I'm saying it Indian entity 1 and Indian entity 2. Okay? I will again go back. Now, Rule 2AA of non-debt instrument DI rules. Indian entity shall mean an Indian company or a LLP. So Indian entity means shall mean an Indian company or a LLP. And the NDI rules defines Indian company means a company incorporated in India. Again, you will have to go through Companies Act. And LLP means a limited liability formed and registered under the Limited Liability Partnership. I think this way I have covered it. Now, downstream investment by LLP, not owned and not controlled by resident Indian or controlled by persons resident outside India. So here, if you see foreign investor is investing 100% in an LLP, who in turn is investing in Indian company. So foreign investment of 100% is permitted provided there are no FDI linked performance conditions. Now, downstream investment by banking company, foreign owned or controlled banking company. First block, investment done under corporate debt restructuring or other loan restructuring mechanism due to defaults in loan will not be considered as indirect foreign investment. But however, if there is a strategic downstream investment, then it will be considered as indirect foreign investment. So there is a corporate restructuring done and there is an investment in it due to defaults in whatever it is, but there is a restructuring done in it. And there is further investment which has been brought in. That will not be considered as indirect foreign investment. But if it is for a strategic part, then yes, it will be considered as an indirect foreign investment. So FDI, Schedule 1, Schedule 2, 3, 6, 7, 8, and equity 2% resulting from conversion of any debt instrument. This is the brief FDI. There is Schedule 4 also, because but Schedule 4 is not covered under because it is on a non-repatriation basis, so it is. Downstream investment, we are continuing with investment vehicles. Investment vehicles means an entity registered and regulated under the regulation framed by the SEBI or any other authority designated for the purpose, say REIT, investment InvITs and AIFs. Ownership of an Indian company shall mean beneficial holding of more than 50% of the equity instrument or contribution of more than 50% in capital and having majority profit share in an LLP. Shareholding equity person more than 50%, that is an ownership. But company owned by resident Indian, it includes ownership is vested in ASEAN or Indian companies which are ultimately owned and controlled by resident Indian citizens. And LLP owned by resident Indian citizens, so again, it is owned and controlled by resident Indian citizens. Company owned by persons resident outside India, against what we have seen for person resident in India. That means because companies owned by person resident in India, what we have seen is the ownership of an Indian company. What does it mean? Beneficial owner holding of more than 50% of equity instrument. That means beneficial holding is a person who is person resident outside India. That is covered under the next part. So that should be an ownership of an Indian company. Since we are dealing with FDI rules, I'm just dealing with person resident outside India. So if we are holding, say 60%, person resident is holding 60% in the Indian company, then it is called a company owned by person resident outside India. or not owned by person resident in India. Control, again now the new feature, company owned and company control. Both are now come under separate categories of it. So control, what does it mean? It has a right to appoint majority of the directors or to control the management or policy decisions, including by virtue of the shareholding or management right or shareholder agreement or voting agreement. And for the purpose of LLP, control shall mean right to appoint majority of the designated partners. So what does control? Control means appoint majority of directors or control the policy decisions of the company. And what does in LLP means? Right to appoint majority of the designated partners and or have control over the policies of an LLP. Company controlled by resident Indian citizens means an Indian company, the control of which is vested in resident Indian citizens and or Indian companies which are ultimately owned and controlled by resident Indian citizens. So again, company controlled by resident Indian citizens is that you are the person who are resident in India. So that if you are holding the company, then you have meant to say that you are a person resident in India, and it is called company controlled by resident Indian citizens. And here it is on the citizenship, mind you. So if you are a foreign citizen, it will not. Even if you are a person resident in India, then also you will not be covered over it. Same thing with company controlled by person resident outside India shall mean an Indian company that is controlled by person resident outside India. An LLP controlled by person resident. So again, you will have to be careful, see what it is, and then you have to decide, because ultimately for direct downstream investment or indirect foreign investment, you will have to say accordingly. Total foreign investment means the total of foreign investment and indirect foreign investment, and the same shall be reckoned on a fully diluted basis. Foreign investment and indirect foreign investment will be considered as a total foreign investment. Strategic downstream investment means investment by banking companies incorporated in their subsidiaries, which we have seen. Holding companies shall mean, as per the Companies Act 2013, Section 246 of the Companies Act defines holding company in relation to one or more companies, means a company of which such companies are subsidiary companies. And Section 2AA of FEM says Indian entity shall mean an Indian company or LLP. Now again, 287 defines subsidiary company. 287 of the Companies Act 2013. Subsidiary company or subsidiary in a relation to other company, that is to say the means a company in which the holding company controls the composition of the board of directors. Suppose if an Indian company is having is being held 100% by foreign company, or it is held say 70%, then also it will be called as a holding company which controls the composition of the board of directors or exercise control of more than one half of the total share capital, either on its own or together with one or more of the subsidiaries companies. For the purpose of this clause, a company shall be deemed to be a subsidiary of the holding company, even if the control referred to him. I'll not go through now because this is a holding company. Now, guidelines for calculating total foreign investment in Indian companies. Any equity holding by a person resident outside India. This will be taking it into the flowchart also. So first we'll understand it, and then we will understand through case studies and so. Any equity holding by a person resident outside India, resulting from conversion of any debt instrument under an arrangement, shall be reckoned for total foreign investment. So any conversion of any debt instrument, so that will be under an arrangement, shall be reckoned as a foreign investment. FCCB, foreign convertible bond, foreign currency convertible bonds, and deposit receipts having underlying instrument in the nature of debt shall not be reckoned for total foreign investment. So if you have got FCCBs or DIs where you are not converting, its underlying nature is debt only, where it is only under pure debt where you are going to repay it, then it will not be treated as a foreign, it will not be considered for total foreign investment. And this should be applied at each and every stage of investment. So if there are 4 layers, then first layer, second layer, third layer, fourth layer, you'll have to see every time. Portfolio investment, you'll have to consider it at the 31st March of previous financing. Indirect foreign investment received by WS of an Indian company limited to foreign in total foreign investment received by the company making the downstream investment. Again, indirect foreign investment received by a WS of an Indian company. That means Indian entity 2 limited to the total foreign investment received by the company making the downstream investment. This is very important because that will understand it. Limited to the total foreign investment received by the company making the downstream investment, right? So I'll go there. Foreign company is holding 75% in Indian company 1 is holding 21%, 26% in Indian company 2. So indirect investment will be 26% only and not 75% of 26%. Same thing is with, because there is a proportionate, this is not 100%. Here then it is 75%, 80% and again 80%. But if foreign company is holding 75% in Indian company 1, Indian entity, and in turn it holds 100% in Indian entity 2, then indirect investment will be considered 75%. This is the meaning of this. Otherwise, whatever Indian company 1 has invested, it will be considered for Indian company 2, it will be considered as indirect foreign investment of 80% and 26% if it is 20%. This is the meaning of this. Investing company, I company 1 is foreign control owned into Indian company 2 will be considered as indirect. It does not say about proportionality for computation. What I have said is, and foreign investment less than 50% in company 1 would not be considered a downstream investment if it's invested in I company 2. Now take another example. Say suppose this is 45% and this remains at 26%. Then there will be no indirect investment because this has to be, F company has to invest more than 50% in Indian company 1, Indian entity 1, what we can. Then only it is considered as indirect foreign investment. Now take this. This I will just explain again with another example. F company 1, foreign company 1, I'll just open it up. Foreign company 1 has invested 100% in Indian company 1A, first level, which in turn has invested into 40% in Indian company 2 level. Foreign company 2 has invested 40% in Indian company 1B. This is the first level for F company 2. In turn, he has invested 60% in Indian company 2, second level. The balance 60% in Indian company 1B is invested by an Indian resident. 60% is invested. So here 60% is from F company 2 and 40% is from F company 1. So, and Indian company 2 again invest in Indian company 3. So what is the total investment? Investment by Indian company 1B is domestic investment because it is less than 40%. This is F company 2 has invested less than 40%. So it is treated as domestic investment and not of FDI, as it is controlled by Indian resident. Investment by I company 1A is 40% in I company 2. I company 2 becomes a domestic investor because now this may be a foreign investment, indirect, 40%, but here it is 60%. So when they invest into I company 3, then this will be deemed as a domestic investment. So this will be treated as a domestic investment because this is 60% they are holding. 60% is by non-resident. This is also being held 60%, if you see. So this 60%, if we see, then it becomes a domestic investment. So the domestic investment continues this through for this also. I company 2 also because at first level it is domestic investment. So obviously second investment level is also domestic investment, and that is also 60%, and this becomes 40%. So again this becomes domestic investment, and so when they invest in third level, it also automatically becomes domestic. This is the purpose of this foreign company. So this is the indirect, all the charts, flow charts of all the guidelines which they have given, how to calculate. What are the conditions? Approval of board of directors, shareholders, investment from funds received outside India and or equity instruments. Leveraging from domestic market is not permitted. That means you cannot take loan from domestic market and issue and invest. Reporting to RBI, that is there. Pricing guidelines to be adhered. Reporting by statutory auditor in case of qualified report, then report to RBI Tribunal office, and compliance of rules to be mentioned in the director's report. Bring requisites funds from abroad, not use funds borrowed in the domestic market. Internal accruals profit transfer to reserve account, that will be treated as a foreign investment. Raising of debts and its utilization shall be in compliance with the Act, rules or regulations. Raising of debts means outside India. Notify Secretary for Industrial Assistance within 30 days of investment, even if the instrument has not been allotted. So there is an investment, you just inform them. Previously under FDI, what we used to do is that when funds were issued, we used to inform the RBI that okay, now we have received the funds within 30 days. Now that is not there. Now you have to directly do it in FCGPR, report in FCGPR. Form DI to be filed with RBI if it is domestic investment within 30 days again. Responsibility of compliance, who is responsible? First level Indian company making downstream investment will ensure. Certificate from statutory auditors on annual basis. Compliance of FEMA provisions shall be always be there, and qualified report again, report to RBI. Now what are the conditions for exit? Indian entity receiving foreign investment may transfer equity instrument to person resident outside India, subject to reporting requirements from FCPA and pricing guidelines. To person resident outside India, subject to adherence to pricing. An Indian company with foreign investment not controlled by resident Indian citizen, owned or controlled by person resident outside India, pricing and reporting guidelines will not apply. Now let us go into the case studies. Foreign investor has invested in Indian company 1, which in turn has invested into LLP. Whether that is permitted or not, whether downstream investment by Indian company 1 is permitted in LLP. What does Master Direction Para 9.3 says? 9.3.3. Indirect foreign investment is permitted in an LLP in sectors where foreign investment is allowed under 100% automatic route and there are no FDI linked performance conditions. So invest in LLP only if there is a foreign investment of 100% is allowed. That means Schedule 1 again you have to, and there are no FDI linked performance. So retail trading, then what we call other sectors which are there where there are FDI convert, real estate, where there are performance conditions are there, that you will have to see that then if it is not if it is there in the Schedule 1, then you will not be allowed to permit to invest in LLP even if it is allowed under 100%. Suppose there is 100% you are permitted, but there are FDI linked performance conditions, then you are not allowed to invest in LLP. Definition of indirect foreign investment means downstream investment received by an Indian entity from which another Indian entity which has received foreign investment. So received by an Indian entity which is received from another Indian entity which has received foreign investment. An Indian entity shall mean Indian company or LLP. So Indian company 1 is permitted to make investment, downstream investment in LLP, subject to conditions of 100% automatic route, and there are no FDI linked conditions. Both have to be cumulatively covered. Okay, so now foreign investor has invested in LLP. Now LLP wants to invest in another LLP. I'm not going into the LLP Act whether they are permitted or not, because by and large LLP is permitted to invest in LLP, but not either. I'm not sure about the company. So LLP wants to invest in either LLP or a company. So whether downstream investment by an LLP in LLP or company is permitted. Explanation to Rule 23(1), downstream investment by an LLP, not owned and not controlled by resident Indian citizens, or it is controlled by person resident outside India. FDI is permitted under automatic route and no FDI linked performance conditions is attached. Definition again we have seen. So LLP can make investment in LLP and company, subject to LLP Act, which is case study 3 now. And now this is on the schedule 4, NRI investor. Although we have not gone into schedule 4, but I'm still taking it into it because this will become relevant to understand. Invest in Indian company 1, and in turn it becomes Indian company 2. NRI invested is Indian company under schedule 4. Whether investment by Indian company 1 will be treated as downstream investment or not. Schedule 4 investment is not considered as FDI. Downstream investment made not a FDI. It will not be treated as a downstream investment according to Rule 23. Here, the foreign investor has rendered services to an Indian company, who in turn wants to issue shares to a foreign investor. So, what the services render, whether it is permitted or not. Rule 23(4), the Indian entity making downstream investment shall bring requisite funds from abroad. We have seen already this, not with fund borrowed in the domestic market, or downstream investment may be made through internal accruals. Internal accruals shall mean profit transferred to reserve account after payment of taxes. So Rule 23(4) doesn't cover rendering issue of shares against rendering of services. So you cannot, the Indian company will not be able to issue shares against rendering of service. This is as far as downstream investment is concerned. I am not talking about FDI rule person. This is only at the second level. Here, I have not gone into it because already it wanted to issue shares of it. So that's why I have not gone into I company 2. Now foreign investor China. It wants to invest in Indian company 1, and in turn it wants to invest in Indian company 2. Indian company 1 has pre-existing FDI from China. The Indian company intends to make downstream investment. Whether downstream investment is permitted by Indian company 1 in view of press note number 3. For non-resident entity can invest in India subject to FDI policy. However, an entity of a country which says land border with India, or while the beneficial owner of an investment into India is situated in or is a citizen of any such country, can invest only under the government route. So here already we have got an investor from China, and he is already invested into Indian company. Now there is an Indian company 2 which the Indian company 1 wishes to make downstream investment. What does the regulation says? That even if there is a beneficial owner, so here what will happen? Who will be a beneficial owner of I company 2? It will be the foreign investor China. So here it will not be permitted to make downstream investment by I company 1 to Indian company 2. Now, in foreign investor want to invest in Indian company 1, he has invested, and in turn he wants to invest in Indian company 2 in redeemable preferences. Whether Indian company 1 can do so. Explanation G, what does it says? Downstream investment shall mean investment by an Indian entity which has a total foreign investment. Foreign investment means any equity instrument by a person on a repatriable basis in equity instrument. Equity instrument means last rule 2K. Equity shares, convertible debentures, preference shares, and share warrants issued by a company. So this is convertible preference shares. Since it is not the redeemable, so it can be treated as foreign. 1 second. Yeah. So equity instrument means equity shares, convertible debentures, preference shares, and share warrants issued by an Indian. Now there are certain compounding features. Euroschool Properties and Infrastructure Private Limited, order dated 7/10. Company has made two downstream investment and filed Form DI, which was filed by 2 years, 3 months, and 20 days late, which has to be actually done in 30 days. This is in 20, Forma 20 when this was compounding whatever issue. Amount involved was 29 crores or something, and compounding fee was levied as 22 lakh 43,000. Same thing with Pearson. They had to report in DI form in RBI, which they don't do, and the amount involved was hardly 4,000, and compounding fee was 70 rupees only. More than the amount involved at the compounding fee, it would have been this professional fees which should have been. So first, now I'll take the queries, Mr. Dr. Salim.
Sir, you're audible, sir. Just give me a moment. So if you could go in the chat box, question number 5, 6, 7, 8, 9. There are 5 questions.
Yeah.
And if those questions could be attended, and apart from that, if you could give an overview on today's decision of cancelling the FCRA licenses of 2 NGOs, and what was the reason to it, and how did it go about, so that the fraternity could understand and accordingly advise their clients or people who have enrolled with them for these services. It can make them very convenient for them to handle and guide, so that the clients do not fall in such pit and they are streamlined from the day one.
Okay. Yeah. Now, question is, what if startup company issue says less than FME? There are instances where valuation is higher, but investors are not willing to invest in such prices. In that case, what are the other options available? No, you'll have to go to RBI for the permissions. You'll have no option but to go. NRI is holding equity in unlisted company acquired while he was resident. Does the company need to file FLA every year also in cases of NRI is holding equity while he was resident? In cases of buyback of shares, are there any reporting requirements? First part, NRI is holding equity in unlisted where he was resident does not. But see, NRI is holding it equity when he was a resident, so it is on a non-repatriable basis. Once it is not on non-repatriable basis, then you are not covered under FDI. So if you are not covered under FDI, then you don't have to comply with any regulation, and therefore FLA should not be. Because for filing FLA, you will have to first report under FCGPR. You will be given the number. Once you get the number, then only you will be able to file FLA. Also, in case of buyback of shares, are there reporting requirements? I presume it is continuation where it is being the buyback of shares is continued is as per the in the resident investment, which will be considered as domestic investment, not FTI, and therefore there will be no report. Suppose we have taken FIPB approval earlier and approval, and then the industry open up, then do we have to inform any changes? No object clause, and no, now there is no requirement because now it is under the, but it is better that you just under approval route. So what you do is it is as an abundant precaution, you write to FIPB or to the respective ministry, because now FIPB is not there. So as to respective ministry and to RBI that this is the case where we have taken, and now we have changed the object clause of business. if non-resident forms an Indian company in 2004 hospital, brought funds through automatic route and bought land to build hotel. Now that sell that land, buy other land to build hotel. I'll sale of land. They don't try to circumvent the rule because this is RBI provisions. I'll read the question. If non-residents formed an Indian company in 2014 for hospitality business, brought funds through automatic route and bought land to build hotel, but could not build it. Now, that company with NRS shareholders wants to sell that land and buy other land to build hotel. Sale of land and a new purchase of land shall require RBI's permission. Yes, I would say you would go better for it. Otherwise, it will be seeing that you are dealing in real estate business. Because say you have purchased the land in say Mumbai, you wanted to build a hotel, but it could not comply with the local conditions or of anything. So now you want to build a hotel in Delhi because that is easier to build a hotel, and you want to purchase the land over there. But then RBI may see with this colored eye because of the land prices going up in Mumbai with a higher rate. So you now want to shift your focus to this, and this you had purchased it for the purpose of dealing in land. So it is better you go for RBI. Company has received foreign investment from individual investor in the year 2016 who resides in the USA. The company has to file FCGPR. What is the remedy to the investor? If not, no remedy. Then you comply with all the regulations. You file FCGPR. You either file late filing fees, but if it is very exorbitant because it is 0.15% and 0.05% and all. So if you find it exorbitant, then you first comply with all the regulations and then you go for compounding. But after filing FCGPR also, you'll have to comply with the FLA regulations. FLA forms also you'll have to file it every year for all the periods from 16, 17, 18, 19, 20, 21 and now 22 is peak. So you'll have to file all the FLA forms. So both FCGPR and FLA. So you may just go for the compounding, and compounding fees are now less. So you can try for this. Is the benefit of deferred payment allowed to person resident under Rule 96 available to WFH PROI in India? 96. One sec, I'll just go through 96. In case of transfer of equity instrument between a person resident in India and person resident outside India, an amount not exceeding 25% of the total consideration. Yes, it is under available to WF or such PROI in India. Now there can be once it is a WIS, then how can be a deferred payment? Because WIS is only purchasing it. So if there are any regulations which you have to comply with and you go for deferred payment, then it's okay. Otherwise, why do you want? Because it's a WIS. Here, when it is a joint venture, at that time the people enter it. So I would say that unless it is true, because other regulations are there which you have to comply with it and you are not able to comply. Otherwise, I don't think so that this benefit you should take. Because otherwise, then again, RBI will take up with differently. So I would not advise at least. Okay. Now coming to FECRA part. This
Exactly, sir. Right, which I had already talked about because this would be an insight. There are a lot of opinions and ambiguity because the thing has come to the news. So
yeah,
you could just highlight something.
Yeah, this has been used as like 3-4 years. What has happened was why FECRA has been become now they are implementing it vigorously because you had received funds. Say Indian trust has received funds from the foreign person donation under FECRA. Everything was registered and everything was there. But while utilizing it, it was utilized for the purpose other than for what purpose it was taken. And the forms were filed just like that, that yes, we have invested it. But when they investigated it, that time they found that they had not utilized the funds as mentioned in the FECRA license. So that's why they have come out with her. I mean, I will not mention it because this is the public forum for what purpose, what they had find out, because it will not be good on that part, because I will not mention that what violation the trust has done. But for the purpose for which it was brought, the donation was given to the trust. That purpose, for that purpose, the funds was not utilized. Suppose, I say, I'm just giving an example. I'm not giving a real example. Say I have brought in funds. I would say that I want to build a hostel for the students. And that's why I have brought in say $1 million, and I had taken donation from foreigners $1 million, and I had taken a FECRA license also, and I have got a bank account also, and it is lying in there. But something happened and I couldn't materialize, and I now don't use funds for that hostel purpose. So what I had brought in for hostel purpose, so I'm not utilizing it. No, so what I do now? Okay, I brought the funds. So what I will do is, okay, I will use it for the purpose of hospital. But then, if you want to use it for the purpose of hospital, then you should again go back to FECRA, go amend the license, and then you can utilize it with an agreement from the donor that okay, I've given for this could not, but now they want to construct an hospital, they want to run an hospital. So you take that license, go back to FECRA. For FECRA is Foreign Contribution Regulation. Go back to them, go back to Home Ministry. You say, okay, you have brought this fund, I've taken a license, but now it couldn't materialize. Give the reasons why it could not materialize, and you once you say that, and you take a license. If not license, you tell them that okay, if you are not giving us license, how now I should deal with this money? Then you cannot utilize it anyhow you like. Then you should seek the permission from the Home Ministry, whatever. This is crux of this, that what was not, what funds they had brought, what donation they had received, the purpose for which was not achieved, and they use it for the other purposes. I think
So
that
basically, you have talked about the compliance part, that this idea should be given to the client in case they are looking for permissions, or they should be advised it that the thing doesn't end here. And as per the rules, you are utilizing the funds provided for some other work rather than for what you have been authorized or licensed for. Then they should again go back and do it. So this is what the people practicing over here, and looking into licensing and the licensing part of it should get into. That is what your opinion is.
okay, once you take a FECRA license, it doesn't end here. As Dr. Salim said, it doesn't end here. Every once the year ends, you have to file it within by September or December next. You have to file Form 4 online with the Ministry of Home Affairs. And there you have to give all the details, the funds you have brought in, where you have utilized it. All the detailed is there. Detailed form is there. For what purpose you have utilized, where you have utilized. You give, and there you have to give the trustees, all the names of the trustees which are there of the trust, their Aadhaar card number, PAN card number, and the purpose for which it has been utilized. Most importantly, bank account, from which bank account statement you have to attach. So these are the important things. These are the compliance. And mind you, this is being monitored by them. Day in, day out there. Once you speak to them, it is monitored by them. Okay, this was the FECRA license given. On the basis of this FECRA license is there. Now you have filed Form 4. Form 4 you have filed it. So for this purpose you have filed it. Okay, now they will look into the details. And if they want, they will go for further inquiry, and they will write you letter that okay, you have shown this. Now let us have the proofs of it or anything. If they want, they can go into the detailed and proof of it. So this is the compliance part, and compliance part is not that easy, because if you have diverted the funds then to for the utilization certificate which you have to give, because that utilization certificate has also been taken from the this CA. So that utilization certificate is also to be from charter, and charter accountant will should have to be cautious when he is giving this certificate, because ultimately it is monitored by the trust Ministry of Home Affairs, Home Ministry. So this is the major part of the compliance.
what is the approximate consulting fees for the licensing part if someone is looking at it?
That depends. That is not like fixed or anything.
There's no benchmark.
There's no benchmark on it.
But then too, generally, how it works on a percentage or on a benchmark?
No, it is never on percentage. CS cannot take on percentage. That is when our institute. But it ranges from the professional services, what type the professional services. They want to have only consultancy or they want to go and take as a permission. Because permission also getting a license also, it takes minimum 6 months to 12 months. Minimum. It is not that easy. And they make full inquiry of the they go all out in that.
There's tough scrutiny. That is what you're saying.
Very tough. Now it is become very tough. So it is not that. So it is minimum 6 months to 12 months. So sorry. Yeah.
Yes, I can.
No. So you'll have to be extremely careful while filling up the form, while forming the trust, everything, while taking permissions, everything. You'll have to be extremely. And about that, after taking all the permissions, you will have to see that you comply and you do as per the activities that is permitted as per the trust deed and as permitted under FEMA license and what you had tasked for. That is basic.
So in case of any discrepancy or non-disclosure from the client, does the liability is equally on the chartered accountant?
If it is certified, then yes, it will be. If
you have to take due diligence.
Yeah, if we have certified it that for this activity purpose has been utilization certificate, then yes. So he has to be very vigilant on this.
Fantastic, sir. Even I learned a lot of things, although my expertise is not in what you're, speaking or mentoring us to be very right today. And very nicely you went through, and I especially like the presentation about the, investments where you took the foreign companies investing into Indian companies and they investing into LLPs. And, very nicely it just went into my mind, okay, here how we take only 25% as an investment, or how we take 80%, or how we take 100%. And very nicely, like it is something tough. You really streamlined it for all of us.
Thank you. Now,
this was really a very great session, sir. If you could share your contact details for the people in the fraternity.
Do you want
exactly?
To cover anything, because nowadays it's almost 6. So
right.
Do you want me to cover, or should I cover the non-residential the schedule 4?
So we'll stick to the time, because this is very rigid. When we have the time slot over here, it becomes very rigid.
Okay.
Because then the members also might have other work scheduled, which they might have join or go on. But that's the reason why I asked you to put in your slide of your contact details, so that
it is.
The members take the benefit of it.
Yeah, just there is a contact details.
And I'm sure there would be members who are inclined to go ahead with this session. But yes, in case we want you to come back again, and obviously which should be there, then we'll again have this session with more longer duration.
Yeah, sure. No problem. Anytime.
So thank you so much, sir, on behalf of the entire committee, on behalf of Dr. Raj Kumar Adukia ji, and with his support and the committee's initiative, this is how we are able to have such programs for the benefit of the chartered from our fraternity. So thank you so much, sir, for your contribution over here. And I've also noted down your details. Maybe I'll also be interested.
Okay,
thank you so much.
At the outset, I will also thank the Institute of Chartered Accountants, Rajkumar, the chairman of this, for giving me this opportunity to share my thoughts. And I also in turn learned a lot while preparing this presentation, because it was a very long presentation. Almost 108 slides are there. I had discussed with also, I will not be able to complete because it's a very long. It may take to complete it if you want to go in detail. Because
fantastic, sir. But whatever you mentored us and put us today, it is directly gone to our brains, especially because of the slides that you have prepared. It made your work easier to explain and our work easier to understand.
Thank you, sir. Thank you very much. Thank you.
Thank you so much, sir. Thank you.